She said, sideways. So I'm like, what you mean sideways? Meaning we'll have like one or two similar questions.
looks a little overcast out here.
Good afternoon. Good afternoon.
Good afternoon, Mr. Nordich. How you doing, sir?
Thanks. How are you?
I'm doing well, thank you.
Okay. All right. We're going to get started in 6:14 in 1 minute. Kendra, can you see my screen, the PowerPoint?
Yes, sir, I can.
Okay. Good, good.
Too hot to be wearing long sleeves.
Okay, good afternoon.
Good afternoon.
Okay, I see that the review so far. It's 6:15, actually 6:16, so we'll get started. Okay, what we'll do is we'll review, do a quick review of last class. Okay, so those of you who have your books, you can follow through with your books. As far as that information is in your books. Okay. Okay. Okay, so as I said, we'll review the previous lesson and then we'll get into today's lesson. So on Tuesday, we began the course. We did a brief course overview, which included me giving my email address. So it's gnottage.bifs@gmail.com. Okay. I indicated that there would be an in-class case study. This you'll find on pages 101 to 108 in the textbook. We'll go through this as we go through different portions of the workbook that are related to this. We'll begin putting together a This is a case study on building a loan application. Okay, and so as we go through each section relative to it, we'll begin looking at the Martin and Sherry role case study, which begins on page 101 of your textbook. As I mentioned last class, homework assignments are due a week from the day given. So if I give them on Tuesday, it'll be due the following Tuesday. If I give them on Thursday, it'll be due the following Thursday. Okay, and you send them electronically. No late assignments accepted. So you can send them up to me up to, so Tuesday night. If it's due Tuesday night, you can send up to 11:59 p.m. Once the clock strikes 12, it's a late assignment for Wednesday morning. And so similarly, if it's due on Thursdays, up to 11:59 p.m. on Thursday, once the clock strikes 12 for Friday morning, the assignment is late, okay? With our graded scripts, they'll be returned and we discuss the following class. So, so Tuesdays, homeworks, when I accept them, I'll grade them, return them for Thursday's class. We discuss them Thursday's class, and similar for homeworks running on Thursdays, graded and returned on next Tuesday. Okay. So the format, as I mentioned last week, your homework assignments for the most part until we possibly with the exception we start dealing with the case study. You'll have some case study type questions which are mainly fill in the blanks kind of assignments, but for the most part your homework assignments will be true and false, multiple choice, fill in the blanks. The final exam will be the same as the above, plus one in class case study type question. Okay, there's no midterm exam because this is a summer session. Oh, and may I say that read on Tuesday that passed, that classes will start at 6:15 instead of 6. Okay, and so we scheduled in at 8:45. Okay, again, I mentioned last week that about 75% of the course is concerning credit operations, and another 20-25% is on international business operations. So there'll be a minimum of 10 chapters covered during this course, in module 1, and a minimum of 2 chapters covered in module 2. So just an insertion here that I didn't mention last week, and on Tuesday's class, is that for your success, attend classes, ask questions and participate in class, discussions and class activities, do your pre-reading, and it says and rereading. So sometimes you have to just scan through a chapter and then reread it, either in another sitting or the same sitting, and go through it slower. Okay. Because well, I'll wait to comment after I've done number 5. So complete your end of chapter questions and submit your homework assignments. The end of chapter questions and the homework assignments kind of point you in the direction of where the questions will be in terms of your final exam. Okay, and so 6 is to actually sit the final exam, and then there's a special note during 1 to 5 will ensure success in 6. Okay, so since we were talking about exams, so you can see the weighting of the final exam. The final exam is 50%, attendance is 10, participation is 10, and homework SASH quizzes are 30%. Are there any questions on that?
No, sir.
Okay, no questions. Okay. So last class we looked at this little schematic diagram here. So we will, like I said, we'll go through the process of talking about loans. And so some of you have been exposed to the lending, some of you have not. And so this goes from A to Z in terms of lending. So we talk about how banks make the money, from depositors coming and depositing to the bank using that money to grant loans, and those loans are used for different purposes, mortgages, consumer loans, credit cards, and then of course there's also business loans, and there are other types of credit, credit lines, overdrafts, and that sort of thing. But on the flip side of that, we will have to also look at at what happens if we're human, we make mistakes. So from time to time, we're going to book a loan that might not be quite, or approve a loan that doesn't quite, isn't a good loan. And even those ones that are good loans that start out with all the promise and all the T's across and I's are dotted, sometimes things happen in people's lives. COVID-19 is a reminder to all of us that in the split second, we can all be affected worldwide by any natural or international pandemic. And so, so the bottom part of your screen illustrates that sometimes you may have to take the stick to get so to speak, to get your money out of your clients. Sometimes you have to use the carrot approach. What is the firm approach and what is the soft approach? Sometimes it ends up you having to take legal action either through the magistrate's court or the Supreme Court to enforce your collateral security, if you have collateral security, or to even go after the client after their own financial means. Collateral, it means then that you may foreclose on that. You may repossess a car or cash in on any stocks, shares, or bonds that the client may have placed. Okay. Some things we want to keep in mind, and if you hear me using them interchangeably, but if you hear me using them, they're being used interchangeably. So when we talk about loans or lending, we may also talk about credit. We may also talk about advances. Okay, so that is one of the first set of words that is used interchangeably: lending, credit, loans, advances. The second one that is also used interchangeably is saying the bank or financial institution. Normally, you will find financial institution is the go-to word nowadays. Okay, so financial institution, or you'll see the abbreviations FI. And then the third one is banker, lender, loan officer, loan manager. And then there's some other names of various banks give. But I think one of the more common ones used nowadays is lender. Okay, because it can refer to the bank or any institution who lends money. Okay, because we have some car dealerships who lend money, lend money, so they are lenders. Okay, So again, last class, we looked at chapters 1 and 2, and we talked about how banks are up, and most of the commercial banks are listed here on that screen. We also mentioned that there are credit unions that now come under the umbrella of the central bank, and so they're governed by the central bank. Then, of course, you have some of the other lenders out there. So you have easy loans and some of the other lending institutions, Bahamas Development Bank, the Bahamas Mortgage Corporation. We talked a bit about deposits and loans. Those have been the two key, two of the key main areas of a bank that come to our mind when we talk about banks, because people make deposits or put deposits or place deposits into a bank, and the same people or others will go there and borrow against funds that have been deposited for loans. We indicated that it's significant that the loans, that the deposits were weighed heavier than the loans in this scale, because you have to have much more deposits than you can lend out loans. You can't lend out, or you shouldn't be lending out more than you have. I don't know how that is possible. I know people borrow more than they can pay back, but no financial institution can lend out more than they take in deposits. And we looked at some of the services offered, and we in the book it has 3, on the PowerPoint it has 2, so deposits, loans, foreign exchange. Some of the others that we looked at: credit cards, teller or tellering, compliance, human resources, your IT department or computer department. So those are some of the ones that were given as examples on Tuesday. Then we looked at this little chart here about deposits and loans. We talked about Frugal Fred putting his money into the bank, and we said that the deposit for the depositor was an asset. What did we say that the deposit was for the bank? Was it an asset or liability?
Liability.
Anybody have a different opinion? Okay, so the deposit is a liability for the bank. All right. Anyone wants to say why the deposit is a liability for the bank as opposed to an asset?
Because it's getting back what they would have loaned out.
I didn't get that because you started to break up. So if you don't mind repeating, please.
Because they're getting back what they would have loaned out.
Okay. So we said and I think that may be for on the other side of the coin, but the money is an asset to Fred because Fred is himself basically lending that money to the bank or placing that money into the bank, so it's an asset because he owns it, right? It's a liability to the bank because the bank doesn't own that. Okay.
Sorry, I had to go the wrong way.
Yes. Okay.
Okay.
So it's a liability to the bank because they don't own that. They at any moment, Fred comes and their friends say, "I want my money." They got to give Fred his money. Okay. So when you look at a bank's balance sheet, it will list deposits as a liability or as liabilities or deposits liabilities. Don't be surprised. Don't be shocked at that. So there are a number of banks. Well, even in newspapers, they'll post their year-end financials. But there's also a number of them that are publicly traded. So like, Commonwealth Bank, Finco. So you can look at their balance sheets, and in fact, most of them also have their booklets, and in their annual reports, nice, colorful, expensive, glossy booklets. They have their financial returns for a certain period under review. So most of them now will have them out for 2021, and most of them are available at the financial institutions. If they don't have any in their foyers, you may be able to ask them for it, and they should be able to give it to you. So like your Fidelity, like I said, your Commonwealth Bank, Finco, and the government bank is also public knowledge. That's Bank of the Bahamas, right? So the deposit is an asset for the client or for the customer, but it is a liability for the bank. On the other side, the loan is a liability for the borrower. And what is it for the bank?
An asset for the bank.
It's an asset for the bank, okay? And why would it be an asset for the bank?
It would be considered an asset because on their balance sheet, it would be listed as an accounts receivable, which means they're going to be paid that, and that's going to be revenue that they would be receiving in.
Right, because it's money that they're entitled to. It's a receivable, yes. Okay, so good stuff. Okay, so we looked at reserve requirements that help us to understand why the bank will not be lending out all of the money, and it's also a precaution to prevent some financial institutions from being a little too greedy and trying to lend out all the money and have nothing to fall back on. Notwithstanding that in the Bahamas, we have a limited deposit insurance, if you want just to call it that, where each customer is insured up to $50,000 per customer. So it's not per account, it's per customer at each bank. Okay. So if you have $150,000, put $50,000 in 3 different banks or financial institutions that are covered. So when I say banks, I'm also referring to credit unions. Okay. So banks are prohibited from using reserve requirements to extend loans to customers, and there are 2 categories. They're your primary reserves, which are called your statutory reserve, and then there's your secondary reserves, which are also called your liquid asset ratio, sorry. So when you look at your primary reserves and your secondary reserves, you add them together, it gives you your total reserves. So you add 1 and 2 together, and the total of those 2 is the amount of money that once you have lent out every other cent, and you come to that number, you can't lend out anymore. All right. And then we looked at question number 7 at the end of the chapter, talking about Cat Island Bank. And we said that they had the $950 million in liability, $100 million in demand deposits, $500 million in savings and fixed Central Bank of the Bahamas or interbank borrowing of $30 million. And you actually calculate the primary reserve, calculate the secondary reserve, and then we are asked what is the total reserve requirement. And so that is what we did. We calculated the primary reserve, we calculated the secondary reserve, and then we calculated or added 1 and 2 in order to get the total reserve. Okay. And again, as I said, you apart from this question on this chapter, you wouldn't have a question to calculate reserve requirements. You may be asked about, can you lend against reserves or reserves or something like that? To be asked. I have never posed a question in a quiz, homework, or final exam about calculating. Okay, so this is really just to help you to understand what goes on behind the scenes in your in your finance unit, your accounting unit. Okay. Then we looked at what is lending. We looked at some definitions. We said is lending or credit an art or a science, or is it both? And I think we all came to the conclusion that it is a bit of both. We looked at reasons banks lend and to whom they lend. We also looked at the importance of know your customer policies, due diligence, and money laundering awareness. And we also ended by looking at 3 key aspects of lending. So understanding risk, assessing risk, and managing risk. And when we discussed about art or science, we said that science relates to using assessment tools. Some of us were introduced to the canons of lending for the first time, and some of us became aware that something that we were using, Campari, was actually called the canons of lending. Okay, then there's debt service ratios, and there are also financial ratios when you're dealing with businesses. And then we said that it's a science also because it is quantitative, it's concrete, it's concerned with facts, numbers, statistics, etc. And then we said it was an art because it's based upon experience and skill. It was qualitative as opposed to being quantitative like science, and qualitative because it's subjective and abstract. And usually, again, it comes with experience and time. Okay. Some people acquire that skill quicker than others, but the art is really something that has to, you have to begin doing credits, looking at applications and whatnot in order to gain that experience and that skill. And extracted from our textbook, again, lending is both an art and science. It combines the science of obtaining and analyzing the facts concerning a loan application and the art of making judgments about that information. And then there's the other one, science, et cetera, et cetera, et cetera. Okay. Then we looked at reasons when institutions lend. So we say they lend to individuals, they lend to businesses, they lend to other organizations, and they lend to governments. The 2 things that we're concerned with here are individuals and businesses, but more so individuals in this course, to less extent businesses, because business lending is a little bit more involved and in depth. So while we'll be looking at some aspects of the borrowing around businesses, what is required of them, et cetera, we really won't be getting into business loans per se. We will touch on different aspects right here and there. So for example, tonight we will be looking at different types of business structures. We were looking at what they're required to provide to the bank. And then later on, maybe next week or week after, we'll be looking at businesses in terms of doing pricing. Actually, it'll probably be the week after. Okay. So we said that some of the reasons that individuals and businesses that we lend actually to individuals and businesses is that they require funding that they may usually have on hand. That interest income from loans or lending products represents the primary source of revenue for financial institution. Okay, that is very important. The interest income from loans represents a primary source of revenue for financial institutions. There are a whole lot of other products, but lending out money by far is the biggest income earner for financial institutions or lenders. Financial institutions also charge fees for setting up and renewing lending facilities. And these are also a significant source of revenue. Now you see they're saying charge fees for renewing lending facilities. One such lending facility that they charge fees on for renewal will be overdrafts. Overdrafts are normally for about a bit of 12 months or less. Banks do not do overdrafts longer than 12 months, and then they're subject to review. And if you want the overdraft to continue for the next year, then you pay another, you charge the client another set of fees. Also, business facilities are, even though the business may get that loan for 5 or 10 or 17 years or whatever the case may be, they are reviewed on an annual basis, and there's a fee on an annual basis for the renewal. Generally speaking, some banks may be moving away from this, but for the most part, business loans are charged annual fees. Okay. So the reasons that individuals and or businesses borrow. First, we look at individuals. We said that they do it to establish credit relationships. And if you remember, we said that that may not necessarily be applicable today because most banks, you can walk into them today without any credit relationship with them, and they give you a loan, okay? Once you provide adequate collateral, you show that you're a good payer in the past to some other place, or you have salary that is assignable or deductible, and that company or operation is acceptable to them to do the deduction, they will do the loan. Also, to finance large items over time, such as apartments, houses, and other investments, so to speak, to cover shortfall and daily expenses. And we said one of the ways of doing that is through the overdraft facility. To purchase various items such as vehicles, furniture, appliances, and also to short obligations such as school fees or generally tuition fees. Then businesses borrow to fill the gap between accounts receivables and accounts payable, or for working capital requirements. So this might be a lump sum that they do, or it may also be an overdraft, similar to the individuals who use it to cover shortfall in the daily expenses. Businesses might not be able to obtain credit from suppliers, and we indicated on Tuesday that is normally for startup businesses who don't have a track record yet. So businesses would have to come to the bank to see if they can borrow the money, as opposed to setting up credit. But say if they're in the retail grocery business, setting up at ASH Pritchard or the Albinos or one of those other large suppliers. The business might also need to purchase highly priced items, such as production equipment, etc. Or they may want to fund a project or expansion. So they might want to expand the location where they are presently, or they may want to set up another location on the island, or even in another, in one of the family islands. Okay. Then we looked at, why isn't this moving? Okay, it's not moving. Okay. Okay, start moving again. All right, so reasons to properly assess the risk of each borrower, because you want to minimize bad debts. You want to ensure the lender's profitability. You want to protect the lender's image and reputation. You want to price your loans correctly. You want to justify the decision to lend. So you'll document and rationalize the reason for your decision, particularly if you're looking at approving a loan that falls out some of your guidelines, your established guidelines. You want to protect the shareholders' interest. That is the various owners of the bank, whether it's an international body or local shareholders, or a combination of international owners and local shareholders. You want to mitigate risk, and you want to prevent money laundering and terrorist financing. Okay. And the importance of adhering to KYC and due diligence requirements, because it is an essential component of a financial institution's risk management and compliance practices. You want to contribute to the overall safety and soundness of your organization. You want to protect the integrity of the financial services sector, and you want to avoid making advances or loans or giving credits where the down payment or the collateral security or source of the payment has been derived from unlawful activities, okay, such as money laundering or terrorist financing. Okay. And then, of course, we ended the chapter, as I said earlier. Understanding risk is it an art or science? All risks are not equal. Assessing risk using assessment tools, COMPARE, which is the canon of lending, or some people say canon of good lending. Your credit Cs, and we'll be looking at COMPARE and credit Cs in detail later on, doing financial analysis. Again, we won't look at that in this course, although there's a chapter on it. Debt ratios, credit reports, etc. Managing risk using reports. We talked a little bit about some of our daily, weekly, monthly, quarterly reports, especially the system-generated ones, such as our overdraft and overlimit accounts, exception reports, etc. And that ended that chapter, and that's where we ended the class. Okay. Any questions on that before I begin chapter 3?
No, pretty straightforward.
Okay. So we move on to types of customers, chapter 3, which is begins on page 9, is it? Yeah, sorry, page 11. Hey, how could they? My one is missing page. My book is missing page 9 and 10.
Page 10 deals with the review questions on chapter 2.
Yeah. Okay. Yeah. Okay. Alrighty. I'm just noticing that the book they provided me with. I'm not this week. I'm not using my normal textbook that I use. I'll begin using that next week. I'm just going according to the book that they've given me, and it's missing that page. Just make sure, go through your textbook to make sure that you have all the pages. And if there are any pages missing, please contact the Institute so that you can get those, any pages that you may be missing. Okay. So we can move to chapter 3. Types of business customers, well, types of customers. And we begin by looking at the types of business customers. So the 3 that we'll be looking at is the sole trader, which is also referred to as the sole proprietorship. We also look at, we'll be also looking at the partnership, and we'll also be looking at the corporation or company, right? And we're looking at the different aspects of them and get a better understanding as to why people may choose to do a partnership as opposed to proprietorship or a company. as opposed to partnership, et cetera, et cetera. So we'll get an understanding as to what is required in the operations formation of these different business entities. So the first one is the sole trader or sole proprietorship. This is a one man or one woman operation, and they normally will trade as a business operation. So in your on your bank accounts, you may see, for example, Glenn Nottage, Glenn Nottage trading as Shoe Wonder. Okay. Another term used is DBA, D as in dog, B as in boy, A as in apple. That stands for doing business as. So some financial institutions use trading as, and some financial institutions use doing business as, DBA. Okay. One of the challenges with the sole trader or the proprietorship or sole proprietorship is that he or she suffers all losses or all benefits from all profits. Okay, so if the business does well, the proprietor does well. If it does poorly, the proprietor does poorly. Okay, he or she would have limited access to capital, generally speaking, because when you, if you are a proprietor, a single person trying to, a single individual trying to get financing, usually you don't have the resources required to satisfy bank's requirements. And so let's say you may need $100,000 to start a business venture, but you may only have $50,000 worth of collateral. But I should say the client may only have $50,000 worth of collateral. So it makes it difficult for the proprietor to raise capital or to get to have access to capital. The loan must be in his or her personal name, and hence that's why it says, for example, Glenn Nottage trading as Shoe Wonder or whatever it is. The business ceases to exist in the event of death. Legally, that's what should happen, but in the Bahamas, the reality is that sometimes you have a family member, it might be a spouse, significant other, or maybe a child or a number of children who will continue to run let's say, for example, this is a community convenience store or convenience shop, a little grocery shop. You'll find that one of the children or the spouse or the significant other, the common law spouse, will continue to run the business. All you'll notice, the person died, you'll know that the person is there no longer because you don't see them there, and they probably have a black wreath on the door. But the business doesn't stop. They keep going with the business. And what may happen is the people just won't be putting the money in that person's trading as account. They'll probably be putting the money somewhere else or keep it in a locked in somewhere, hidden somewhere until they get organized. But really what should happen is the trading as account should cease business. And if you want if someone else wants to start that business, then they have to go through the process of providing the required information to us as banks or lenders to have the account set up in their name. Okay, while the person who had the trading as account, while their estate is being probated, either where there's no will or whether there is a will. So the estate will have to be probated. The business, okay, we touched on that, ceases to exist in the event of death. There's limited management resources in most cases, unless that person hires a skilled person or persons. So and again, in this convenience store, if I sell meats, then I will hire someone to do the meats, to cut the meats, to do the butchering, or I may hire an accountant to deal with my books, or hire somebody at the cash register while I deal with the general management of the account. I remember back when I was a boy, my father had a grocery store, and he and my mom did everything in the store. They were the butchers. They were the people who did the cash register. They made even deliveries to some of their clients' houses. This was back in the 1960s. So, things were different then. And then, of course, you had the two of them, you see. So whenever any butchering needed to be done, my mom would come. The house was next door to the shop. My mom would come over, do the butchering or whatever it is. Or when my daddy needed to go to lunch, she would come in and fill in while he got his lunch, etc. But in today's world, even if you are the sole proprietor of that type of establishment, you still need to hire somebody either at the cash register or doing some of the other things to stock taking, replenishing your shelves, and that sort of stuff. It's kind of difficult for, unless it's a very small shop, for you to do all those different things, a single person. And then, of course, the last one is that the proprietor, he or she, is liable, personally liable, for any and all claims that might arise. So it's not just limited to that business. So if I have, again, this little convenience store, and let's say I do a loan, I make a loan, the bank approves the loan is defaulted, the bank will not just come after the business, but the bank will come after everything that I own. So it'll be my car, any personal stocks and shares I have, any other properties I own. The bank can come after anything when there's a sole proprietor. Okay. Any questions on that, arising from that, or in anything I said?
Mr. Nadish, I just need to pick your brain on this one. Relative to what you just said in regards to being liable, in the case of where there are multiple accounts held by the same individual in a particular organization, is it standard whereby you can actually have an account set aside that cannot be touched, even in the event of some defaulting on other accounts?
Unless there's some signed agreement to that effect, the financial institution could go after anything in that person's name. Okay, where there's an and or account, if it's a joint account where it's and or, they can go after it. If it's an and account, they might be prohibited from going after it because it's an and account. Okay, but if it's an and or account, or if it's a or account, they could go after anything, or the single name, they could go after it. I hope that answers your question.
Okay, sir. Yeah, because I had heard somebody said that where I was in elections, that persons in the past, what they had done is they had requested a particular account that should not be, like you said, an agreement being signed, that nothing can be touched on this particular account if there's a shortfall or default on another account. Okay, but that explains it.
And this was in the person's personal names, not a business name.
I think it was, the scenario was, it was both. There was a business involved, but they also had a personal account that they had with the same institution, but they wanted it to be separate and apart and different from the actual business account.
Okay, so they borrowed. Was this an incorporated business or trading as business?
I didn't get those particulars. That's why I asked.
Because this is if it was an incorporated business, okay. If it was an incorporated business, several things come into play. If it's an incorporated business, they only limited, and we'll see that in a few minutes, they only limited to go after the assets of the business. However, and this is where it gets a little sticky for a lot of people, because financial institutions, we ask the business owners, the company owners, to personally guarantee.
Okay.
Okay. And so if the person has personally guaranteed that, okay, they're a guarantor, you can go after the guarantor for any and everything that he or she owns, similar to a sole proprietor. So there's some different scenarios that come into play. So in that instance, you would have to know whether or not it was an incorporated company. If it was an incorporated company, business entity that he had, but he also had funds in his personal name, okay, and he did not guarantee that business loan. They could not touch his money in his personal name. But if he guaranteed that facility, based on the wordings of most guarantees, they then could have access to that money.
Okay.
Okay. Excellent question, by the way, and great scenario that you presented.
Yeah, because
Go ahead.
no, I was saying when they presented it, I said as a collector, as a former collector, I said anything that, like you were saying, in their names, I'm pursuing. And then they said it all depends. If he has some agreement in place whereby if there is a default on a loan, then you cannot touch this particular account. If it's set up at the beginning of the relationship, prior to the loan or the facilities, then you can't touch it. I say, okay, no problem. But I don't think many banks do that, do they?
Well, you see, banks would do it if they're not, we're not going to volunteer it. Okay, we're not going to volunteer it. So the savvy business person will make that request to the bank. But banks, we're not going to, we're not going to make the client aware that will, if you don't want us to touch that money, because we want to get our money. We want, and especially if it's a substantial amount, let's say the business is a risky business. It's a very risky business. The collateral that we have is, let's say we only have a debenture over, and again, we're going to be looking at some forms of collateral. We may have a debenture, and a debenture is a type of charge document, like a mortgage is a charge document over property. When you have a chattel mortgage is a charge document over chattels, such as cars and that sort of stuff. So a debenture is a charge over the assets of a business, right? So, and that debenture could be over what they call the fixed assets of that business, as well as it could be also on the floating assets of that business. So the fixed assets would be if, for example, if the owner owns the building, it could be on the building. If they own the equipment, let's say this is a grocery store, so they have coolers, shelving, and all that type of stuff, air conditioning units, blah, blah, blah. Those are fixed assets. The floating assets will be normally your stock and trade, your inventory. And it's called floating because, I may have a whole bunch of cornflakes now, but that gets sold and that's replaced with Rice Krispies. So, but what you're looking at is I take it over a value of your stock. So it may be over $50,000 worth of your stock. So whatever your stock is at that time, whether it's cornflakes or Rice Krispies, I take over your stock. And so it's called floating because I guess it floats away, it moves. I guess there's movement. And that's why they call it floating assets, as opposed to fixed assets, which traditionally don't move, okay? Or are difficult to move, all right? So, yeah.
That brings clarity for me, sir.
Okay. Any other questions from anyone else?
No, I got nothing right now.
Okay. Well, if you have something later, we bring it up later. or you can shoot me an email or next class. This course you're taking. It's worthwhile. Even if you don't go into lending as a financial industry person, you can always benefit from this from a personal perspective, because I perceive that all of you are fairly young, and so you don't want to be working for somebody all your lives. So you may be thinking of what I could do as a business eventually, right? And so a lot of this information you can now start putting together. Oh, this is nice to know, because when I get ready to start my business and move from here, this is good information. And I find that when you have that type of mindset, you tend to retain some of this information greater than if you look at it from, when I work in the bank, I need to know this kind of information, blah, blah, blah. But if you look at it from a personal, what if I wanted to do this as an individual, you tend to remember it more. Okay, so just a little point I threw that in there. That's worth $50, but I gave it to you free tonight. Okay.
Incorporate the business. That's what you do.
Yeah, basically.
Yes.
Protect your assets.
Yeah. Okay. So let's look at partnership now. Okay. So the partnership is two more persons, and it could also be a trading as business operation. Okay. The more formal partnerships that we are used to are the partnerships, say like accounting firms, law firms, doctors' offices. Those are also partnerships, but they fall more under the corporation or company because they are incorporated. Okay, so this partnership is kind of like a loose partnership. So you have like two persons, and they're trading as two or more persons, and they're trading as whatever it is. Okay, so for example, it may be, Glenn Nordage and Susie Q trading as best tilers in the Bahamas. Okay, so we have this tiling business, but we're partners, and one may be more active than the other, or both may be just as active. One may be more the money person behind it, or the brains. The other one may be the actual person who does the tiling. Okay, but it's a partnership. These benefits and disadvantages are similar as with the sole trade or proprietorship. And we'll see here that the partnership ceases upon death, resignation, or termination of any partner. Okay, and so sometimes you'll see that happening even with incorporated partnerships. And one of the more notable ones that I normally use is that of two of our former prime ministers and one who's the present prime minister. Okay, their partnership started out as Christie Ingram and Co. So it's Christie Ingram and Co. Mr. Christie became prime minister, and so then the partnership ceased, and then it became Ingram, Davis and Co. And then Mr. Ingram became prime minister, and so he came out of the partnership, and it became Davis and Co. Okay, Mr. Davis has become prime minister, and the company still goes on, but he has moved out as an active partner. I forget the name.
Is that by choice, or do they have to do it? Saying that they now have a high post, a higher post.
Well, what you should when you enter politics, when you enter politics, normally you will come.
You hire a scale.
There's something called the Westminster Westminster Code, right? And the Westminster rules. And so while it may not necessarily be a rule, there is a code, and so that is why, for example, you may see The firm has not, I think the gentleman who heads it up now is Mr. Brister, I think, is the top partner, okay? But Mr. Davis still has shareholdings in Davis and Co. Just like when Mr. Christie left the partnership, he left as an active member, but he still had shareholdings in Christie Ingram, Ingram, Davis and Co. Okay, and similarly with Mr. Ingram, when he left, he still had interest in Davis and Co. Okay, because for example, up until I can't remember the year, but there was a time when Christie Ingram and Co. Was on just off Shirley Street, right? I think Elizabeth Avenue it is, I think. And then there was a fire, and then they eventually moved. But Mr. Ingram was prime minister, but he still had ownership in the building. Okay, so the reason it is done is to remove the possibility of the appearance of conflict of interest, and open the way for those businesses to do business with the government at an arm's length transactional basis. Okay, so while we know in practice, there's still some influence there, because you will send business to your buddies kind of thing. Okay. You want to, you want as much as possible to show that you're complying by removing yourself from being active in the company, in the partnership, or in the law firm, right? In this case, so you want to remove yourself. Yes, you get stuff from it, but you do not have a day-to-day interest in its running and its operation. So you're kind of like a passive owner, or they may just agree to pay you a stipend, or they may pay you out altogether. Okay, so that's how it works. And interestingly enough, the new Chief Justice of the Bahamas came out of Davis and Co. He was a partner in Davis and Co. before he went on the bench as first as a magistrate, and then further as a Supreme Court justice. So Mr. Winder, Ian Winder, who's CJ, has come out of Davis and Co.'s law partnership. Okay, and the best that I know of him is that he is a person of integrity. I've dealt with him personally on from a financial perspective when he was first starting out, when he and his wife had finished law school and they returned to the Bahamas. So I found him to be an upright person. So I think, following in the steps of Mr. Brian Marie, we have another quality caliber person serving as our Chief Justice in the Bahamas. I'm surprised that he took it because he's so young. Because I think you can go up to age 69 or 70 as a Chief Justice. Ian is a good ways off from being 70. I don't know if I would want to be a Chief Justice for more than 10 years, but then again, to each his own. But I say that to say this, that, with partnerships and with organizations, you have to take whatever steps are necessary to avoid conflicts of interest or the appearance of conflicts of interest. And we will find, we may not necessarily cover this in this course, but you will find that in your financial institution, for example, they may tell you that you cannot process an application for your mother, your father, your sister, your brother, your husband, your wife, your children, that type of thing, okay? Or someone you may consider a family member, if the relationship is that close. by the extended family. Okay, so again, credit and lending requires that there be no appearance of conflict of interest, that you try to remove any conflicts of interest, because you do not want to. Remember, we looked at one of those things in chapter 2. Where is it? Item number 3: protect the integrity of the financial services sector. Well, it begins with protecting the integrity of your financial institution, right? Okay. So going back to partnership, the partnership ceases to exist with the addition of partners as well. And there doesn't necessarily have to be a actual stopping point and a new starting point per se, because what normally happens is, with the exception of death, unless the person begins to ail, and then you know that in the next few weeks, days, whatever it is, this person's so ill, or like say the person goes into coma, you know that you have to replace the partner, or you have to change your structure, you have to do something legal, right? So, but in the case of I gave of our 3 prime ministers, they knew what was happening. So, for example, they put all the work in place so that at the end of Friday of this week, they were still trading as Ingram, Davis and Co. Monday morning, all the legal work, the paperwork was in place, all their stationery was in place under the new name, Davis and Co. And so Friday, Friday the 10th, they ceased business as Ingram, Davis and Co. Monday the 12th or whatever it is, that's 10th, 11th, 12th, yeah, 12th, they started business as Davis and Co. So it isn't like you have to wait a whole week, a whole month, or whatever it is. If it's anticipated, you can, cease your operations one day and open the next day. And if they did business on Saturdays, they could have ended business on Friday as one entity and open on Saturday as the other entity. So it can be seamless if it's anticipated. But if it's not anticipated, such as in sudden death or hospitalization and persons in a coma, the process may take a little longer. Okay. So limited management resources in most cases, unless they hire skilled persons, again, similar to the proprietorship. The individual, there is individual and or joint liability for any and all claims that might arise. So in the event of a claim against the company, whether it's a defaulted loan or whether someone slips and falls in your business, they can come after any one of the partners, or they can come after you both. Okay. So you may hear some, where it says individual and or joint liability, you may hear the phrase several or jointly liable. Okay. You may hear that phrase, severally or jointly. That's what it means. So they can come after you individually, meaning sever individually apart, or jointly liable. Okay. Any questions on that before I get on to the third business type that we're going to be looking at?
So, Mr. Nordich, just a question. I was looking at the review to see today. So the question that says that if you're the richest owner in the particular company or partner, a person can come after you individually, even though there is a partnership? Yes. They can come after anyone or both. And it doesn't matter if, let's say you and I are in a partnership. I have 40%, I invested 40% of it. You invested 60%. Okay. They can come after me for the whole loan, even though there is no respect of whether
I own less of the business than you do. Okay,
Yeah.
they can come after me for all.
That question kind of had me confused as well. But when I thought about it, I was like, you can't really say the richest partner because the person with the most money may not have be the one with the large percentage of the share within the or have a large percentage partnership in the company. So
It doesn't matter. That's what I'm
yeah,
saying. It doesn't matter. They can come after. They can come after anyone. If you have the in the scenario that you have, I may be the richest of the two, and I only have 40%. Okay, someone not as rich has 60%. Okay, they look at they look at my assets and they see I got cash that is sufficient, or an asset that is sufficient to cover the debt. They're coming after me. Y'all are coming after me as a bank. Okay, and that's the risk that you take doing a partnership, a trading as partnership. The way to avoid that is to form a company or corporation.
Indemnity insurance.
And even at that, well, the indemnity insurance, if you can get it, I don't know if it's available in the Bahamas, but even with the corporation of the company, that is difficult because we as bankers, we ask the two partners, if it's incorporated, we ask the two partners to guarantee. And by default, the guarantee eliminates the ratio of ownership in the business. You see, so under an incorporated company or business or corporation, if I own 40% and someone else owns 60%, the profits, I get 40%, they get 60%. If the business has to wind up and there's some debt, I'm responsible for 40%, they're responsible for 60%. However, if there's a loan and we both guaranteed it, they could come after either one of us or both of us. And that is why you have people who have incorporated their businesses. They push back against us as bankers when we ask for them to guarantee a loan, because they said, I'm relying upon the strength of my business to pay this back, not me personally. But most of us banks, or lenders, we're not hearing that. We want you to personally guarantee it because we want to be able to get our money back.
Okay, that brings some clarity to that.
Okay. So, types of business customers, sole trade. I'm sorry, I went backwards, eh? No. Okay. Types of businesses, corporation, company. Okay. It is the most expensive structure, and again, because see, you now using lawyers and that type of thing, because you're incorporating, so the fees are greater. So it's the most expensive structure to have. Okay, and then the annual fees for your company to get your to keep your company license, not just your business license, but your company license. Okay, so and then you have to do financials, so you have to pay an accountant at a certain level, although that now requires that we all submit returns, so we require some sort of accounting. Although businesses, I think under $100,000 or 100,000 and less, they can the Internal Revenue would accept financials done in-house, but they must be signed off by a CPA. So, in that way, it's not as expensive. They're unaudited. The CPA just looks at it and say, okay, yeah, that's cool. Everything looks like it's in order, but they never examine your books per se. Okay. For those who have the in-house who do the financials, and a lot of them they use QuickBooks, etc., etc. So there's more of a pool of persons to draw knowledge from in the corporation or company, and that is because you have more people involved and more skilled in the expertise of various persons. If one owner dies, resigns, or quits, the company still goes on doing business. Okay, and that is one of the benefits and of doing a company or a corporation. And again, that's probably one of the reasons why it's more expensive. You're paying for some of these benefits. Generally, a corporation or company has greater access to capital, usually through share issues, etc. And they have limited liability, generally speaking, although that could be circumvented in some instances. And one of those instances I already shared with you, where they ask to guarantee. And of course, this last one ties in with the third point. There's continuity. So it goes back to, if one owner dies, resigns, or quits, the company still goes on doing business. Generally speaking, if all the owners die, the business can still go on. Because normally those persons will have named who will carry on, who has the right to their shares, ownership in the company. And so they'll just, continue the business. All right. Any questions on that?
I'm good.
Okay, so we've looked at the different types of customers, okay, business customers, that is. Let's look at the lending options available to those three different types of business customers. And again, we'll start with the sole trader, sole proprietor. Okay, so those facilities that are available to him or her are term loans in the personal name, overdraft facilities in their personal name, credit cards in their personal name, mortgages in their personal name. They can do customs bonds in their personal names, or trading as name. They can do customs check writing facilities in their personal or trading as name. And they can do performance bonds in their personal or trading as names. Now, some of those items you may not be aware, have knowledge of, like customs bonds, customs check writing facilities, performance bonds, but we'll be looking at those. I think should be in the next chapter. Yes, that would be in chapter 4. Okay. So any questions on that before I move on?
No, sir.
Okay.
No, sir.
Okay. So types of how am I going backwards? All right. Okay. So for the partnership, again, similar to the sole proprietor, term loans in their personal names, overdraft facilities in their personal names, credit cards in their personal names, mortgage or mortgages in their personal names, customs bonds in their personal or trading as names, customs check writing facilities in their personal trading as names, and performance bonds in their personal trading as names. Let me say those last three for the individual, it could be in their personal or their trading as names, because the nature of customs bonds or customs check writing facilities or customs bonds is a business venture. And so the goods and services coming to them may be in their trading as name. So it may come in their name, trading as, or may come in their trading as name. And that is because often when they are ordering from abroad, in order to get certain concessions or rates or whatever it is, they have to produce a business license or to be able to buy from a particular, so to avail themselves of cost savings, to buy bulk, they have to show that they, or even to get into a certain wholesaling venture, you have to show that you have a business in the Bahamas. Okay, so that is why the customs bond can be their personal names and or their trading names. Okay, so that's both for proprietors and the partnerships, and that applies to customs bonds, custom check writing facilities, and performance bonds. Okay, performance bonds are not for import purposes. They are, as I say, performance bond normally used by contractors for the most part, right? Or people involved in construction or something similar. But again, we will look at the three of those types of facilities later on when we get into chapter 4. Okay. So the corporation or the company, they can get term loans in the name of the company, overdrafts in the name of the company, credit cards in the name of the company, a mortgage in the name of the company, a performance bond in the name of the company, letters of credit in the name of the company, customs writing facility in the name of the company. Okay, and you see there's a new item there, letters of credit. Okay, that is used in locally and international trade. And so that initially here in this segment, and we'll also look at it in module number 2, international operations, because it's a tool of trade that is used internationally. Okay. So any questions on that before we move on to the next section?
I'm good, sir.
Okay, and everyone else is good?
Yes, sir.
Well,
Sorry, I'm multitasking
Okay, no
again.
problem. You would work again, eh? Weekend, doing two jobs at the same time. I admire you. I used to be able to do that. So I admire you. Okay, so let's move on to the middle of page 12, where we discuss and review the relevance of the company's articles and memorandum of association to us as lenders. So let's look at the borrowing company, okay? Because that affects the borrowing company, okay? And so the borrowing company, here are some key things to be aware of. The articles and memorandum of association, that is their that outlines what they can and what they cannot do. Okay, the articles and memorandum of association. Okay. Then there's the borrowing resolution. So well, first of all, let me just touch quickly on, well, no, let me just go through the 3 of them, through the 5 of them. So there's articles and memorandum of association, there's the borrowing resolution, there's a resolution to appoint bankers, there's the company seal, and then there's a certificate of good standing or a certificate of incorporation. And those are 2 different things. Those are not interchangeable, 2 different things. Okay. So we start with the articles and memorandum of association.
Thank you for calling our billing department. Danielle speaking. How may I help?
You're gonna have to mute your phone, mute your because we can hear you on the phone. Okay, so articles and memorandum of association, that outlines what you can or cannot do, as well as some other things, which we will get to in a moment. The borrowing resolution, the importance of the articles and memorandum of association to the lender is that we need to know if this company can borrow, okay? Because in there it'll say whether or not, in the articles and memorandum, it will indicate whether they can borrow and the extent to which they can borrow and whether they can pledge any assets of the company or how they can pledge, and it'll say who can borrow. So that's important to the financial institution. So if a company comes to you to borrow, the first thing you want to do is look at the articles and memorandum of association, or at least a copy of it, a good copy of it. And if they cannot borrow, then there's no need to entertain the loan, okay, the loan application, because they cannot borrow, right? The borrowing resolution comes when you have decided as a lender that you're going to lend this company. And so they need to do a borrowing resolution to say that the company has agreed to borrow from, Glen Knowledge Bank or Biff's Bank, whatever it is, blah, 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 okay? The resolution to appoint bankers, that comes when they initially come to you as a client and they want to open up an account, okay? So usually it's a deposit account. So there's a resolution to appoint bankers. So it'll state, this is another resolution. We hereby appoint this bank to be our bankers. The following persons will be signing on the account, blah, 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 and they'll say what type of account or accounts to open. We open up a checking account in the company's name. We open a checking account also, dash clients, account. We open also a savings account or whatever it is, okay? The company's seal, again, we look at that. That is important because without the company's seal, the borrowing resolution, nor a resolution to appoint bankers is valid, okay? And then, of course, the certificate of good standing and the certificate of incorporation, those are needed. If it's a new company, just being incorporated, under a year, you need a certificate of incorporation. Once they've been in operation for a year or more, the next year they'll need to provide you with a certificate of good standing to say that they've paid all the necessary fees, et cetera, and they are still in operation. Okay, so again, I want you to go to your books because I want you to do some things with the next section. It says, discuss the role of the borrowing resolution and other general company resolutions to a lender. And you see that paragraph, it says a borrowing resolution is required because the company is a separate legal entity. Everyone sees that?
Yes, sir, I see it.
Okay, so here is what I want you to do, because there are 5 components to this that are important. And so you'll see where it says the articles and memorandum of association will indicate A, what a company can and cannot do in law. So what you want to do is in your book, sorry, I referred you to the wrong thing. The articles and memorandum of association will indicate, sorry, let's go to that. I went down to the bottom, my bad. I better put back on my glasses. Okay, so you see the one that says the articles and memorandum of association will indicate?
Yes, sir, I see it.
Okay, so again, I apologize. That's what I want us to look at first. The articles and memorandum of association. Okay, you should have enough space to insert just above that the letter A in brackets as it is on the screen. Okay, so the articles and memorandum of association will indicate A, what a company can and cannot do in law. So you want to go ahead and do that. Has everyone done that?
Mr. Nottage.
Hello?
My book should be here by next week, I think.
Okay. Okay.
It should be here by next week.
Alrighty. Well, okay. Well, what I will do is I will after this class, either tonight or tomorrow, what I will do is I will send the PowerPoint presentation of what we've done so far in class. Okay, which will include this.
Thank you so
All right.
much, sir.
Okay, thank you.
So, so the articles and memorandum of association will A, indicate what a company can and cannot do in law. Then, why do I? Okay. Then the next one will be, they will, for example, indicate B. So those of you who have your books, insert just between, do that little upside down V to indicate that you're inserting something. B in bracket. If a company can borrow. Then it'll be C, how it can borrow. And D, who is authorized to sign on its behalf. Okay, so it'll say the articles of Memorandum of Association will A, indicate what a company can and cannot do in law. They will, for example, indicate B, if a company can borrow, C, how it can borrow, and D, who is authorized to sign on its behalf. Okay. And then, of course, the last sentence there says, this is known as the company's borrowing power. Okay, the articles and memorandum of association is known as the company's borrowing power. Okay, on that section of the articles and memorandum is known as the company's borrowing power. And then there's a note, not to be confused with the borrowing resolution, which we will discuss next. Okay, because the articles and memorandum is an essential document that is required for a company, a corporation. You must have that. They will only do a borrowing resolution if they're borrowing. They don't have to have a borrowing resolution, because if they never borrow, they don't need to do a borrowing resolution. Okay, so they're two separate things. Okay. Is that clear?
Yes, sir.
Okay, so let's look at the borrowing resolution next. Okay, so this one has, well, you see, that has 5 parts. He said this is known as the company's borrowing power, E. Okay, so we look at the borrowing resolution. Okay, and that has several parts as well. So we'll begin with that. The borrowing resolution is required, A, because a company is a separate legal entity. It is a separate legal entity. So you have to have a borrowing resolution because it's a separate legal entity. The second thing is that it is governed by a board of directors. So it's a separate legal entity and it's governed by a board of directors. And the board of directors are the ones who will be signing these resolutions and making decisions on behalf of the company or corporation. Okay, so A, because the company is a separate legal entity, and B, is governed by a board of directors. The next point, C, sorry. Therefore, in order for a company to borrow legally, C, a resolution is prepared to document that the action, that is the borrowing, etc., has been properly authorized by the board of directors. That's what I was alluding to just now. Okay, that the borrowing has been properly authorized by the board of directors. And that takes us, after that, that takes us to D, okay? This borrowing resolution can and should include details of security and who is authorized to sign the documents on behalf of the company. Okay, so far we have 4 components, and we're about to look at the 5th. Okay, so just like the articles of memorandum, you have that they have 5 components. This also has 5 components, and the 5th one, E, the resolution should be sealed, executed under the company seal. And remember that one of the things we talked about was the company seal. Okay, and the company seal is normally kept by the board secretary or the corporate secretary. They may be one and the same person. Okay, so the board secretary or the corporate secretary keeps the company seal. Okay, so most companies, the corporate secretary is a member of the board, and that is to facilitate ease of business, so you don't have 2 different people carrying out that function. Okay. Any questions on that before I move to the resolution to appoint to appoint bankers? Okay, if there are no questions, at least not now, I'll go on resolution to appoint bankers. A resolution to appoint bankers is the primary document required authorizing the company to open or operate accounts with a bank or financial institution. It states the name of the bank and the type of account or accounts to be opened or operated in the company's name. And like I mentioned earlier, it could be, let's say ABC Developers, and then they'll say dash general account. And that's where all your business transactions, when the customers pay for products, fees, whatever it is, services, it goes into the general account. Okay. Then you have a client's account. Okay. That is where you're holding funds for a client for a specific purpose. A lot of lawyers and real estate firms, accounting firms have client accounts where they'll put client's money. Usually that is placed there in escrow. So for a real estate company, if someone has placed a deposit to buy a property, so they will put that on their client's account as opposed to their general account. And when the sale is closed, when the sale materializes, then the money will move from the client's account to the general account. Okay. So it says, okay, so that's resolution to appoint bankers. Any questions on that before we look at the company seal?
No, sir.
Okay, so let's look at the company seal. And I put some little pictures here to help us. We may have seen some of these things. So all formal documents executed by a company must bear the seal of that company, in keeping with 1, normal sound banking practice, 2, normal sound business practice, and 3, the Companies Act of 1992 and any subsequent amendments. And so you may see a little instrument like that one there with the lever, almost like you lift it up and then you press it down. So when you lift it up, you put the paper underneath there and you press it down, and it'll imprint the seal. Okay, and the seal, it imprints similar to like what you see there, the one that says seal 2025, your company name, blah blah blah. Okay, and sometimes that's put on the paper itself, or these little red with the sticky edges, these little round circles. A lot of them are self-adhesive. You may put them on first, and then what you do is you'll take this, you put these on the paper first, and then you'll put the actual seal over it, press down, and it'll do this imprint on the red circle. Okay. Now, if you're looking at some older documents, you'll see that they actually have this red wax, hard wax, and they have and it's threaded through. They kept together with an eyelet, a little brass round eyelet, and a red ribbon is put through it, tied, and then the two ends of the two ends of the red ribbon are placed on a corner of the document, and this wax is dropped on it while it is hot, and then the company seal is placed on it, and is also done similar for at the end of the document. The reason for that is that they, in the first instance, they don't want the papers to be separated. Okay, because it's a legal document. So for legal documents, you should not be separating. Nowadays, I see a lot of people, because we just use a simple staple now. We don't do the threading thing and the wax, seal wax. So I see a lot of people, they go and they photocopy, they take off the staple, and then they run it through the machine, and then they staple it again, and they have all these staple holes. Okay, well, there's a case in UK common law where someone won a case against a bank because the bank did that. They indicated, they claimed. I've been trying to. I came across a case when I was doing business law and banking law back in 1492, and it was COB at the time, and the institute had just started. So it was quite a long time ago, but I have not been able to find that book, and I've not been able to find that case. But there's a case where the person said that that there was some caveat attached to a guarantee, and that document was missing. Okay, and I'm not sure if they were able to show a copy of it and show that some of the staple holes aligned with those staples, and so they were able to win their case. So one of the things you don't want to do is, when you get a legal document, a conveyance, or any other legal document, a mortgage document, you do not want to, and you need to photocopy it, do not disassemble it by taking out the paperclip. You're gonna have to flip it over, make it as flat as possible, and try to get the best copy that you can. Okay. All right. So that takes us to the mandate. We did company seal. Let's look at the mandate before we go further. So the mandate, a company's mandate is a file maintained by the financial institution, the bank, containing several key documents relating to the company. Among them are the resolution to appoint bankers, which we looked at, the signature card, which is a summary of all the authorized signatories. They list their names, their positions, and any limits. It contains original signatures of the signatories. So when it talks about positions and limits, so for example, it may say the president and the secretary can sign, no, the president and the treasurer can sign by themselves, or for any amount under $50,000. With amounts over $50,000, it requires the signatories of 2 or more individuals. Okay, so that's what it's talking about limits. Then thirdly, you want to keep a copy of the articles and memorandum of Association. And some people may refer, you may hear them refer to these as the arts and memos. Okay. So it's just, they're just abbreviating articles and memorandums. But the arts and memos are the same as the articles and memorandum association. Okay. So the bank should view the original and certify a copy for itself, or request a certified copy from the customer, which it retains. Okay. Then, of course, you want a current annual return and a certificate of good standing. This is for business that is this is for business that has been in operation for a year or more. Okay. And then any other documents that the bank needs to hold in its mandate. Okay. So just as a note here, on the annual return and the certificate of good standing and incorporations, as I mentioned earlier, to tell you the difference between the two of those documents. The annual return, let me deal with that first, indicates the authorized officers of the company, etc. Okay. And that is important because it may change from one year to the next, who the authorized officers are. And then, of course, now the certificate of good standing or the certificate of incorporation. They're two different documents. So this indicates that the company remains on the registry's books in good standing. If the new certificate is not ready, a copy of the registry seat may be obtained conditionally upon receipt of the certificate. Okay. Both of these items are issued by the Registrar General's office. Okay. So again, the certificate of good standing is for a company that's been in business for over a year. And the certificate of incorporation is if it's under a year, it's just been incorporated within that year, because it would not have had time to conduct business where you now require a certificate of good standing. Okay. So while it's still in its infancies, again, under 12 months, certificate of incorporation, over 12 months, a certificate of good standing. Any questions on that?
No, sir. I really am going to appreciate the slides.
Okay, great stuff. Okay, any questions?
No, so.
Okay, no questions. Boy, y'all one set of smart cookies now. Y'all don't have many questions. Okay, y'all are good. All right, we're making some good progress here. All right, so no questions. Let's move on to chapter 4, which will be the last chapter we attempt to cover tonight. So we're going to be looking at types of credit products available. Okay, we kind of touched on this when we were looking at the products available to the various borrowers. Okay, but this kind of we kind of zoom in here. So what I've done is to make it easier for us, I put it here in a chart on your page 15. Okay, and page 16 has a little bit more explanation on them. 16, 17 to the end of the chapter, and this is where we get to talk about those 3 or 4 items. You know, your customs bond, your customs check writing facilities, excuse me, et cetera, et cetera. So, so types of lending or credit products. We have the business product, I mean, the features and benefits. Then we have the individual, the features and benefits, and we'll be able to compare the two. Okay, so the first one that we have here listed as available to the business is an overdraft or a revolving line of credit. Okay, and the benefits are convenience, flexibility, and interest based on usage. Okay, and we'll see that for the individual on a personal product, it is the same thing. Overdraft or revolving line of credit. The benefits or the features and benefits: it's convenient, it's flexible, or offers flexibility, and the interest charged is based on how often you or how much you use the credit line. Okay, so overdraft, convenience. Why is it convenient? Why is an overdraft convenient? Anyone want to venture a guess?
When you don't have the money, you got to overdraft.
Exactly. Okay. If you don't have the money at the time, you do your overdraft. And one of the things you want to do is because the overdraft is supposed to fill in those gaps between accounts payables and receivables for the business. There's a similar thing for us as individuals. Okay. Our payables are our bills, our receivables are our salaries, right? So if a bill comes due on the 15th, but you don't get paid until the 30th, and you have $500 worth of bills that normally comes due around that time, then you want to overdraft facility of about $500. Doesn't make sense getting a $5,000 or $1,000 facility if you only need $500, because the fee that you will be charged or that you charge the client will be based on the $1,000 overdraft facility. Okay, so while the client may not use the full $1,000, they'll be charged because the fee is normally a percentage or a minimum. Okay, it's normally a minimum fee or a percentage of the limit. All right, it's flexible, again, primarily for the same reasons as convenience. So for those businesses who are still accepting checks, it's flexible because you don't have to go and then you can write a check right then and there. You don't have to wait until you get the money, et cetera, et cetera, et cetera. The interest is based on usage. If you don't use it, there's no interest charge. If you use it, you'll be charged for the amount of interest. You'll be charged the amount of interest based on the overdrawn amount. So if you have a $500 limit, you only go overdrawn by 100. The interest will only be on that 100, not the $500. Okay. For those of you who have your books, I want you to add this other bullet point: revolving access to funds. And those of you who don't, again, you'll have the PowerPoint presentation, so you'll be able to add this when you do get your book. Okay, so revolving access to funds. Would that, anyone want to guess what I mean by revolving access to funds?
When you mean like a credit card?
Yes, like a credit card. And why is a credit card a revolving offers revolving access to funds? What happens with a credit card? Do you have to when you go and you get a credit card, they give you what, a limit, right?
Yeah, and you have to keep replenishing the funds in order to use the card.
Exactly. That's why it's called revolving access to funds. You can go up to the limit, and the extent to which you pay it back down, you can then, because they have this thing, available funds, you'll be able to again charge more things based on your available credit. Okay, so a revolving credit line is like a credit card, but you don't have you don't have the actual card, and it is used it is used similarly to the overdraft, but it is a little more complex. And so then when you get into a revolving credit line, they may also charge you, particularly for businesses. For businesses, they may you may be charged on a fee for the amount that you don't use. Okay, so let's say, for example, the interest for any amount that you use the credit line. Okay, let's say the interest rate may be 12%. Okay, and the amount that you don't use may be 3%. Okay, and the reason that a financial institution would do that is because they may want to nudge you to use the credit line and take it up high so they can make the high interest off you. You see, so the bank will get a fee for what you use and what you don't use. And what you don't use is normally a much lower fee than for what you don't use. Okay, but again, the amount that you don't use is greater. So even though the interest rate is lower, so for example, if you get a $10,000 revolving credit line and you only use $1,000 of it, you'll get charged. In the example I gave, you'll be charged 11% on 1,000, but because you didn't use that other 9,000, they'll charge you 3% on the 9,000. You understand what I'm saying? Hello?
I think I do. I think.
Yes.
Okay, I think I heard someone speaking, but it was they were breaking up.
No, I said I think I understand what you're saying.
Okay. Yeah. So we get them coming and going, so to speak. Okay. So again, that example, if it's $10,000, the person uses up to $1,000 in the month of June. We charge them 11% on that 1,000, but then we also charge them 3% on the 9,000 that they didn't use. Okay, and that that kind of will nudge you to say, hey, maybe I need to use more. But then the client should then look at the is it beneficial for me to take the overdraft up higher to avoid paying the 3%. So for example, if I could use some more stock and my return margin or my profit margin on that additional $1,000 of stock is going to more than offset that 3% on an additional, say, I would take it up to 2,000 instead of 1,000. So that extra 1,000 that I have taken my credit line up to, if that the equivalent of that stock is going to bring me more returns, then it's worthwhile me going and using my credit line higher, because I'll make up more for that 3% on unused portion, because I have I use $1,000, but I'm making a higher profit margin on the profit margin is sufficient to more than cover that. So it'll be a business decision by your client whether or not it is worth it. Okay. Even if they don't need it at the time, but they may say to take advantage, probably say of a sale or reduction in some prices, as well as saying, hey, maybe with some marketing, I could probably do some gimmick that say, hey, you come in, I take 15% off, and so that may increase the sale of that particular item, and therefore help to compensate. So it's something that the business will have to determine that they want to do, the business owner. Okay. Sometimes it's available to individuals, but banks are careful to give it to individuals because they want to make sure that you understand what it is you're doing. Okay. The next item is the corporate credit card or the personal credit card. And we see that the benefits are the same for both. Short-term financing, interest-free if paid in full by due date, or there's a certain cycle date that people realize that that they can make the payment and avoid having to pay any interest at all. If they pay it before that particular date, based on their cycle. It offers a sense of security, so I don't have to be carrying around cash, large wads of cash. It's convenient, again, because I don't have to carry cash. My wallet will be, or my purse will be thinner, because I don't have a bunch of cash. I have just this plastic. Then there's easy expense reconciliation. I look at my statement, I can see where I spent the money. It's also security for the client because in the event of a fraud or a suspected fraud case, the credit card company will reimburse immediately. However, if the client uses their debit card or their personal funds, it'll take a while before the bank will do all sorts of investigations. It'll probably take a month or more before the financial institution reimburse the client. So more and more people are getting savvy to that, and so they're now more and more people are paying their bills, including their electricity bills, with their utility bills, by the credit card to reconcile, and is also for security reasons. Okay, so if somebody in one of the utilities does a little hanky-panky and tries to pay their own utility bill with it, you can challenge it, or the client can challenge it, and the credit card company will reimburse almost immediately. And of course, there's the term loan. So it's normally called the consumer loan for the individual, or the business loan for the business. It involves installment payments. It's not revolving. They're clear payment terms. So there's a certain amount of money that you have to pay. Okay. And there's a fixed interest rate. So, you know, these are pretty much straightforward vanilla type credit facilities. So you have installment payments, clear payment terms, fixed interest rates. Okay, it's not revolving and up and down like your overdraft or your credit card. Then of course you have your mortgages. You have a commercial mortgage, and then you have mortgages available to individuals, which can be mortgages over residences, land, undeveloped land, investment properties, duplexes, condominiums, etc. And it can also even be an individual getting over a commercial property that they may eventually want to do business on. Okay, and you'll find out that the mortgages normally have longer repayment terms, so they'll be like 20 years or 20, 25 years, some even 30 years. So the repayment terms are longer than the consumer loans or the business loans. The interest rates on mortgages compared to loans and credit cards and overdrafts are generally tend to be lower. And with the mortgages, you accumulate equity over time. And the reason you accumulate equity over time, equity is what the client owns in the property. And it normally starts out, because we require that they put in at least 10% for lot purposes, sometimes 20% or more. So if the customer starts out with 10% equity injection into the property, they begin by owning 10%. And then as they pay down the principal on that mortgage, their equity interest accumulates over a period of time. So by the midterm by the midterm of that mortgage, you'll find that more of the payment, that's when the equity really starts to get high, or you call it appreciate at a higher rate, because more of the mortgage payment is going towards principal than it is going towards the interest. Okay. Any questions on that?
No, sir, I'm good.
No, so
Okay. So just to recap, the individuals have overdrafts, credit cards, consumer loans, mortgages, etc. Businesses also have overdrafts, credit cards, business loans, commercial mortgages, etc. Okay. Then there are other business products, which start on page 17. Okay, so let's look at some of these. Okay, so let's look at customs bond. Okay, so the customs bond guarantees the payment of import duty up to a specified amount. As the name suggests, this has to do with the customs department. Okay, so for example, a business that wants to bring in some goods, or a trading, whether it's an incorporated business or a partnership or trading as proprietor, they're bringing in goods and services. They may employ a customs bond rather than having to use cash or a check every time they go to the customs department. Okay, so what this is that there's a standardized form. There's a standardized form that the bank would fill out, and the person requesting the customs bond will be required to assign some sort of asset to the bank, usually cash. So the customs bond is normally secured by cash. And with that customs bond, you then take that to the customs department. And so let's say the customs bond is for $50,000, which means that when you bring in items, you can pay for your customs bill up to the value of $50,000. So if I go, let's say this is the month of June, and so the first week of June, I go and I rack up $15,000 worth of customs bills. They will note that on the customs bond, $15,000, which means I have $35,000. So the next week I go, there's another 10,000, so I've taken it up to 25. It means I have 25,000 left. Okay, and when when customs actually receives the cash, because what happens is the bank it will basically be guaranteeing customs that they'll be getting this money. Okay, and if they don't get this money, customs department will then require the bank to pay them. Okay, so at the end of the month, I've only used up $25,000 of it. So I go into customs department and I pay customs. I pay customs the $25,000. Okay, either by a manager's check or personal check if they accept it, etc. Okay, normally it'll be by manager's check or wire transfer, or as the case may be. And then what will happen is then I will have access to that 50,000 again. Okay, so for my next month, having paid the 25, I'll be entitled to the full 50,000, and then I repeat the cycle. So July, I may rack up $45,000. Okay, leaving me with $5,000. If I don't pay that, I'm in July, it goes over into August. August, I can only use the customs bond for the value of $5,000 until I pay that $45,000. Then I'll be entitled to the full $50,000. Okay, but there's a certain period into the next month before Customs Department will call upon the bank to pay the amount owed on the customs bond. And so the business owner or the people who run the company, the corporation, would want to make sure that at the end of every month they pay their customs bill so that they stay in good standing and they don't put their customs bond in jeopardy. Okay, so it's almost like a revolving line of credit where the bank guarantees Customs Department, you're going to get paid. If they don't pay you, we'll end up paying you. And the way they pay Customs Department is if you put up a fixed deposit for $50,000, they will then, and you owe them $25,000, they'll break the fixed deposit, pay Customs Department the $25,000 that you owe them. Understood?
I think so, sir. I think I get that.
Yeah.
No?
I think I get it. I think
Okay, I think someone said no, they didn't get it. Should you need me to go to explain it further?
No, I got it.
Oh, you got it. Okay, all right. Okay, I misunderstood what the no meant. All right. So your customs check writing, it guarantees payment via checks for import duty up to a specified amount. The customs check writing is similar, again, because it's used for the Customs Department. In this instance, what it does is if I can write checks, okay, so I'll give them a check. It's almost like, so, and if that check bounces, then the Customs Department will ask the bank, the financial institution, to pay for that bounce check. But then the customer don't want that to happen because then they can end up canceling the customs check writing facility. So so the customs bond, I can just go there. I have no money. I don't need to use. For the customs bond, I don't need to use any money when I go there. I don't need to use a credit card. I don't need to use a check. Okay. For the customs check writing, I need to use the check because it's coming directly from my account. But again, it guarantees payment made by check. So again, if I don't pay, Customs Department makes a request from the bank will break a fixed deposit and pay Customs Department. Okay, but using checks is something that is that we're moving away from, but there's still some people who are still using checks and some companies or businesses that are still accepting checks as a form of payment. Okay.
Mr. Noda, just a question. Central Bank is planning to move away from checks by the end of 2024 at the beginning.
Yes. The Clearing Banks Association, yes.
Doing that before 2024 or 2023?
But I'm not sure of the actual date, but I know they're moving towards it. And so check writing will then be a thing of the past here in the Bahamas.
Can I solicit your opinion then? With all of the challenges that the regulator has been having with the AFIs relative to sand dollar, do you think that this was a method of actually forcing people to use more digital currency?
Yes, yes, it is. It certainly is.
So the question is, do you really think that's going to work with the Bahamian populace, seeing that it appears that everything is going digital? Another question.
You know, as the world turns, so much the Bahamas. But so sometimes we are ahead of other people, like with the doing away with the 1 cent piece. That was a kind of bitter pill for many people. They say that you know, sometimes you round up, you round down, so you end up winning anyway. But I prefer, but they still give you the option that if you use your credit card, you'll be charged actual cents rather than rounding it to the 5 cents. But you know, I would have preferred us to keep the 1 cent piece. It just that what happened is it became too expensive because a lot of people hoarded the 1 cent piece. They threw it all over the place. And I mean, the mere fact that they collected so many 1 cents shows you the amount of 1 cent pieces that were out there. And you know, I mean, are they going to do it for the 5 cent piece in the next 5-10 years? Who knows? They may do it for all currency, and we all have to use digital currency.
Well, I think that that's where they want to head eventually. Your opinion, I think it was in 2016 or 17 that the economy of India collapsed when they went fully digital.
Sorry, say that again, because you were breaking up.
Just wanting to confirm, I mean, I did hear something relative to a nation that actually went digital, fully digital, that they experienced some major issues in regards to their currency.
Yes, I've heard that, but I haven't had a chance to follow up on it. But if you have something on it, I mean, I'll Google it after class. But if you have something on it, you could send me a link or whatever by email. I'll be very interested in following up on it. But you know, sometimes you see so many different things, and then you wonder, you know, is this just, you know, you may have to use Snoops or one of those other platforms, fact checking platforms to see whether or not this is someone making mischief or not. So there's so many different things that are happening, that people create mischief, and so some of the stuff, unless I see the headlines here in our business section, whatever it is, I pay little attention to it. But something that I would definitely like to look at. But I am a deeply religious man. My beliefs are based on Christianity, and I believe, you know, I don't think it's a conspiracy theory about the, you know, the one world order and the chip out in your forehead or your hand or whatever it is. But you know, we are being desensitized slowly but surely, and that's where we're gonna be controlled. Ultimately, we're gonna be controlled, and instead of just a particular nationality or racial group being slaves, we will all be slaves to somebody,
So
because they will control where we go. I mean, COVID lockdown. I mean, particularly look at the Australia case.
Yeah, yep,
Okay,
yep,
they were very extreme. They were very extreme, and you know, they had their people locked down tight. I was at one point I was doing some financial work for for an Australian firm, and they locked down before us, and they came out of lockdown way after us. So it was rough. It was rough doing business, transacting business with and through them. So, but you know, it's coming. You know, once they can get over the, they can reasonably be assured that they can, to some extent, proof. They can protect it from hackers to a certain extent. You'll see it multiply even at a greater pace, at a faster pace.
I don't think that, I mean, infrastructure wise here, In the Bahamas, I don't know if we're ready for that in regards to our infrastructure. I think that we would be dealing with a tremendous amount of challenges in regards to infrastructure such as Cable Bahamas, BTC, the reliability of being able to see the execution of what needs to happen. I think we will be limited in that particular way. But
Well,
the
let me-
last part with hackers, yeah,
Mhm.
they can have a lot of problems.
Well, we will have a lot of problems because it'll be a do or die situation.
Yeah.
Okay, so if we don't have the technology, no more Bahamians.
Yeah.
You know, unless we scatter to somewhere else, and then by that time we may be, they telling us now, you can't travel to the U.S. unless you're vaccinated and all this sort of stuff. So by plane, you can sneak in there by going by boat. So you hop on one plane, go to Freeport, catch the boat from there, the Bohingi, whatever it is, they have a nail boat service, and get into Florida or whatever it is. So we are being controlled even now. Look at the credit bureau. Okay, all persons who are lending loan providers or credit providers had no other choice. We were all forced under penalty of law of being fined, possibly jailed, if we refuse to join the credit bureau. There are many credit providers who have not qualified, met the standards required by CRIF Bahamas, our credit bureau provider. Okay, but yet they from last year they've been charged the annual fee, whether they've been able to provide information and get up and running or not. Okay, so we've already been dictated to. Okay, I would not have chosen an Italian company to be my credit bureau. Okay, I would have chosen. I mean, it might have cost more, but I would have chosen one of the top three. Experian, and those guys. Because they're being used by Canada as well as the United States of America and also around the world. Okay, so
Because I know they are based, the hub for all the information, to my understanding. Is it still in Jamaica? Because I know that there was some major concerns from what I understood relative to where the information from the Bahamas would be stored in this region.
I'm not sure where it's stored, but the parent company, I think, is Italian.
Yeah,
so some of our meetings, we've had to have our meetings to accommodate them. Sometimes, quite early in the morning, to accommodate them because they're not accommodating us to come later.
I thought from the public discourse and the information that they were giving, that it would be voluntary if you wish to partake. But from what you're saying, and trust me, I believe that what you're saying, they basically put a gun to everybody's head and say, do it or else.
Yes, the act says that if you're deemed to be a credit provider, you must.
From the IMF or IDB. I know
Our act.
March 2018, right?
I think that date is correct. Anyway, our act, our 2018 act. Yes.
Wow. Sorry. I just had some questions.
No. This is fine because this forms a part of credit assessment and modes of payment, some of which will be or would have been covered in international operations, right? So and the beauty of it is that a lot of what we do in terms of local banking is parallel to stuff that that is done for international operations, right? And one of those things, again, like I mentioned, is the letter of credit, okay, which can be used locally or internationally. And so we can look at that partially here, and also we can look at it when we look at international operations, right? I welcome the exchange, and I'm sure it is enlightening to others who are not aware, who are not involved in it to the extent that you are, right? Because we need to be aware of these things and where we're headed. Because if you, and as I mentioned earlier in the class, if you're thinking of setting up your own business, moving away from working for somebody and setting up your own business, you need to be aware of these developments and how you would be impacted as a business owner. How you're going to meet your payments. What challenges would I meet if I have to use sand dollar or some other means of payment? Electronic payment. So.
I think it's if this was something that they were moving into incrementally over the last 10 years, I think at this particular point they would have a lot more acceptance, because from what I'm gathering, a lot of the AFIs are basically looking at sand dollar as a competitor to their debit cards. And if you're looking at saying, okay, central bank is going to back the sand dollar and various things, I'm not going to introduce a product that's going to compete with one of my products and take away money out of my pocket. No, I'm not going to do that. I think that the best thing for the regulator to do is to look at another entity to provide that option. I really think that is, because the banks are going to look at it, unless the pot is sweetened for them, unless you really want to twist arms. I think it's the best thing to look at another entity, another organization, i.e. the cooperative movement, for example. Look at a different entity whereby you can use this digital platform to really maximize it, because it seems as if they can't get off the ground with the declaring banks.
Yeah, well, I mean, the central bank is saying that it's not a platform per se. They're just saying that it's another form of cash payment. I think it's just, to me, it's just semantics. Personally, I'm not interested in using the sand dollar, but if that's where we head and we must do it, then I guess we will have to comply when that time comes. Yeah. But for right now, I'm not actively interested in payments via sand dollar. Personally, I'm not.
I just think that we do a poor job of executing whatever we want to happen. We don't present the benefits, and when you do begin to present something like this, and it seems as if it's almost being forced, Bahamians have a gag reflex. They are going to rebel against it because they feel as if it's being pushed on them, and so they're going to rebel against it. So even if it was something for our good, because of the way that you're presenting it, the way that you're going about it, because there's not enough public information, which I find is a major problem for us as Bahamians. We don't inform, we don't do the necessary, we don't spend the time and the effort and the manpower on doing things the right way. Thus, we run into all kinds of issues.
Yes. Okay. So we have about 3 minutes left. So let me so we've covered customs bond, customs check writing. Let's look at the bid bond and the performance bond. Okay. So the bid bond assures and guarantees that should a bidder, usually for construction jobs, be successful, that he will execute the contract and contracts provided, and provide the required surety bonds. That's the bid bond. So assures and guarantees that should a bidder, usually construction jobs, be successful, he will execute the contracts and provide the required surety bonds. What I'm going to do is, rather than begin looking at that because I wanted to do the bid bond and the performance bond together. We still have the letter of credit or documentary credit to look at. And so what I will do is I will look at these items. Okay, so that'll be the bid bond, the performance bond, the letter of credit or documentary credit. And you see here, they're all written agreements, usually with a standard form or format document, and usually supported by cash. The next screen will show a diagram of the letter of credit, documentary credit, and the flow of payment. And then next class, when we do this, we'll also be looking at a class activity, which I was hoping we'd get into tonight, which I call the matching game. So we'll look at that at the beginning of next class on Tuesday. Okay. Then we'll look at the interview, which is a very short chapter. So for your homework, if you haven't already read chapter 5, it's a short chapter. Well, for class preparation, there's always pre-reading that's required. So you're looking at chapters 5 and 6 for next week's class. Okay. So chapter 6, we begin the credit process. An introduction to that on pages 22 to 26. And I want to remind those of you of the homework, what is crowdfunding, half-page minimum, typewritten, due on Tuesday. And are there any questions before I sign off? I want to keep you later than 8:45.
No, sir.
Okay, so that's it until next class. Okay, and all of you have signed in with your full. All of you signed in with your full full names because they're using that as they're using that as the register.
Yes, sir. I guess when we just log in, it registers that we logged in.
Yes. Okay. Okay. All right. So good night, everyone.
Good night, all. Y'all have a great weekend.
Good
All right,
night.
good night.